Back at the end of January, gold plunged $1,200 or 20% in just days. Since then, it has quietly crawled higher. Is this the next bull advance already underway, or what's next for gold? Good morning, Patrick here, and welcome to our macro outlook for the day. Every day, our goal is the same: to spot the trends early, make better decisions, and stay aligned with the risks. I'm here Monday through Thursday at 9:30 a.m. Eastern. So let's dive into this. All right, so here I have the chart on gold, and we called the play out by play for our members through this entire correction. In the end, it was a direct hit of the 50 day moving average and almost a perfect support hit into the 61.8 retracement. And so you have this scenario where gold did have a violent drop, but it did bounce back off of what it would typically be a pretty key support. Now, normally, if this was a multi-month correction, you should have seen resistance at Fibonacci zones. And what we have seen over the last couple of days is that gold is attempting to beat the Fib zones on the upside. Now, I'm not ready to already say that that is evidence that the next bull run is underway, but the reflexive snapback has been quite strong on the upside of gold. So let's kind of discuss what is the bull case and the bear case for gold. Now, first of all, I actually don't even want to make an outright bear case for gold. To me, there's two scenarios. One, the gold bull market resumes on the upside, or two, gold remains in a multi-month consolidation, absorbing this previous pop and drop, and then resumes the gold run later in the year. Both, I actually think in both scenarios that we'll end up with higher gold prices. So really, this is about a time frame issue. Do you play March and April expirations on an upside bet on gold, or are you simply off on your timing and you're going to run into a duration issue on your options and run out of time before the real actual move gets underway? So what's the case for a prolonged correction? So a prolonged correction is something that we have seen actually in all of the previous gold corrections. And this is the part. So let's look at this chart. And whether you're talking about this gold consolidation here, whether it's this gold consolidation here, or even this gold consolidation here, what are the characteristics that we can show on all of them? Which is the gold low came in pretty quickly. It did not make lower lows, but spent at least 2 to 4 months trading sideways. Go to this one. The gold low came in very, very quickly within a week or so. It did not go to lower lows in any of the previous corrections. And again, spent 4 months trading sideways before the gold breakout resumed. Now go back to last year, where we had the short-term gold peak in October, and it took 2 months, almost 3 months, for gold to break out to a new high to resume its next bull run. And so there's this pattern that happens as gold makes an impulse higher, spends 2 to 4 months absorbing the correction. Usually the first low that's established in the violent correction ends up being the low of the swing, and it's a prolonged period of consolidation. So there's a lot of precedent for this simply to take us through March into April before we are in a situation where gold makes new highs. So is that what's actually playing out? Well, I would say that it's a fair thing to assume that that is because there's precedent for it, that it's very realistic that this can happen again. And under that scenario, drawing it out, we'd have, let's say, a gold reject up along the highs, come test the 50-day moving average, bounce around, create, let's say, a horizontal wedge formation, just basically a fair value of gold being established, a high volume node of fair value being established, and that that base becomes the foundation of a potential new bull run. Now, what's in the favor of the bulls? Well, the thing that's working in the case of the bulls has to be the story of the actual gold miners themselves, because there tends to be strong correlation between gold and gold miners. The gold miners had a much more shallow correction, barely doing a 50% retracement, not even directly hitting the 50-day moving average, and already are trading near 52-week highs. But it's not even just that. There's individual gold names. I'm just going to pick on example of Agnico Eagle, one of the largest gold miners out there, that use that dip as a quick retracement before pole vaulting itself higher to a fresh new 52-week high and running away like it stole something. Bottom line is the gold miners have their own agenda, and certainly are taking some very heavy flows, like if what's going on in actual bullion doesn't even matter. Now, this generally to me is a bullish sign, in a sense that if there was really truly some sort of major blow off top, it would have led to a much stronger profit taking cycle in the miners, and that's just not evident. And so this does bode well for gold, but it doesn't mean that it all has to happen right away. What are some of the things that are constraints in putting on trades right now? Well, one, when we look at gold volatility, we spiked up near 50% implied vols back at the end of January in what was really a crash higher in gold prices. And we remain quite elevated. While it looks like we're 10+% off of the highs from January, one has to recognize is that the long-term gold volatility was actually down in the 15 to 20% range for years. And so only brief spikes above 20% were periods of short and high volatility that saw mean reversion back down to those ranges. We are seeing right now that those reaching for options in the gold market are paying substantial premium, more than 100% more than we have historically seen, to grab at right tail upside. And the skew on those options chains is very heavy, fat right tail. Those out of the money call options are just huge premiums. And so there are a lot of players still out there leaning quite heavily into that right tail, betting that there is still continuation going on. Now, for me, I don't know if I want to use that alone to make a call. I mean, I'm structurally bullish gold in the big picture, like I was saying earlier. I'm not trying to build a bear case, simply trying to solve the puzzle whether or not there's an urgency to be getting back into gold right away with size, or whether or not it's better to wait out a grind and then position ourselves in March or April into a potential upside breakout. It is very interesting. The other kind of things to note, well, let's look at the other precious metals. Silver, while it's certainly trying to get back off of the low end, has not yet even made a solid 50% retracement of its decline. Similarly, when you look at, for instance, platinum, certainly a nice up day, but nowhere near the early resumption of the trend. Same with palladium on the upside, turning up after retracement. Question here, are these flashing new buy signals like that the entire precious metals markets are about to go? This is worth paying attention to, and it's something that I'm going to be talking about in much greater detail with my members. All right, this is where I'm going to end the public portion here and head over with my big picture trading members. Today, we're taking a deep dive into commodities. We're doing our commodity cycle session. This is where we're going to take a deep dive into this oil breakout and what's going on there with many of these energy stocks. We're going to look at the iron ore stocks. Many of them have ripped to these huge extended highs. Is this story running out of steam, or is there more to go? And of course, we're going to dive deeper on how to deal with these precious metals trades and or setups, and whether or not they should be acted upon. We're going to turn all these ideas into actual trades, and that's what we do in that Where's the Trade session. So if you'd like to access, you can start a 14-day free trial You can find the link in this chat, or you can go directly to our website, bigpicturetrading.com. Once you're in, you can click on that big orange button that says join now to join me in that Where's the Trade webinar. Otherwise, the rest of you, I'll see you here tomorrow at 9:30 a.m. Cheers, everyone.